We talked about freight to the seller. So now we're going to talk a little bit about freight to the customer. We have FOB, shipping point or destination. Again, we're going back to that problem where SIUE is selling the iPads to Alton schools. And I'm SIUE. If it's FOB shipping point, that would mean it would be FOB Edwardsville, which means that it would be free until it left Edwardsville, which would mean, again, that the customer will pay the shipping. And FOB destination would be saying that it's free until it gets to Alton, which means SIUE or the seller will pay. If Alton's paying, I don't care as SIUE. Only if it's FOB destination that it makes a difference to me. The shipping costs are $75 for those 10 iPads that I sent to Alton. I know I'm going to pay cash, and it's probably going to be to FedEx or the post office. This I'm going to call freight, or if you can't spell that one, you can call it delivery expense, and then you don't have to remember that EI thing going for the $75. So we're going to expense it rather than include it in our inventory. Inventory should be the cost to get it on the shelf. Anything after that gets expensed. Sometimes it will call it freight out, and freight out is just a regular expense like marketing. On your sheet, I think I've corrected this. The end result is the net income is the same. If I would increase the price and say that I would, see, this is $750 per iPad. So I'd sell it for $507.50. I subtract out my $750. Or if I just said it was $500 and you pay the shipping, I'm still coming up with $500 for my net income. Doesn't really make any difference which you do, you'll end up with the same net income. To help you remember it, on your handout, you have this little table that might help you. If it's FOB shipping point, the buyer increases the inventory cost, and that's called freight in. If it's FOB destination and the seller is paying it, the seller is going to increase the freight expense, and so that's going to be recorded as freight out. Only one person records the freight. So the next thing we want to do, and this is why it's odds and ends. What's the income statement look like? In your book, they've got a single statement and a multi-step. You only have to care about the multi-step. We take our sales minus our cost of goods sold, COGS. Just know what it means. Some students remember it as COGS, and you don't really think, well, all that is the cost of the goods you sold. We care about what the gross profit, some places they'll call it your gross margin. That's a real key number. Then we subtract off, remember this is an expense. Now we subtract off all our other expenses, and we call those operating expenses. We're going to list them all separately, but I didn't give myself much room here, so I'm going to put them little here. We have things like your freight expense that we just talked about. We would have salaries expense, depreciation expense, advertising expense. I'm going to put etc. So you list them all separately, you put the amounts there, you'll total those up, and then that, your gross profit minus your operating expenses, gives you your operating profit. And remember, we said profit and income are two names for the same thing, so some people call it operating income. And this is important to people because that's what you really have left over after running your regular business. We want to make sure that our operating profit is positive. And then we subtract out other revenues and expenses. The one we have talked about that we said was other was discounts forfeited. That goes down here because we said that was a lot like charging people interest. And so we're also going to put interest down in here. That's also other interest, revenue, or expenses. And obviously we would add the revenue and we'd subtract the expenses. Discounts forfeited. If you remember, we recorded sales at the lower amount. And so this is something you would add because it's like interest revenue. And then something we'll talk about in a future chapter are gains and losses from sale of, I'll call it equipment. So these are ways we make money, but if this is the way we're making the majority of our money, we don't have a really viable company. We might charge our customers a little interest. Again, unless I'm a bank, that's not the way I should be making most of my revenue. I should have more up here in this operating profit. The same thing is I can sell off my property, sell off my buildings and make some money, which might be a good thing to do. If I'm making all my money just by selling off my plant, I'm not going to have a good future. That's why we separate those out. That gives us our net income before income taxes. Income taxes are a funny little animal because they're based on our net income. So whatever we have here, a percentage of it goes down here. So I do my income taxes last. That's where you get your net income. The final number is net income, and this is multi-step because we have a couple subtotals along the way that investors especially are very interested in.
I put a pretty version of the multi-step income statement on Blackboard. The next step is to do the gross profit percentage. And that's a very easy ratio, but it's also one of the key ratios that you use to evaluate any product or company or division. Just your gross profit divided by your sales. In this case, it's 7,500 divided by 10,000, or 75%. That means that for every dollar I sell, I get to keep 75% of that. And that number, the higher the better, because you need it to cover all your advertising and salaries and everything else that goes on in your company. If you watch Shark Tank, you'll notice that that's always a question they ask each entrepreneur. If that ratio usually is below 50%, they'll always squirm, make a sour-looking face, and say that's not much margin to work with.